Okay, good morning. Monday, the 18th of December, 2023, and Christmas is a coming. So we are well equipped here with our Santa hat and our Santa Hawaiian shirt. All right, we have a pretty busy week actually on the docket coming up. So if we just kind of slide over here and take a little look at the calendar, so you got the essentially today, Monday, pretty boring, not much going on. Tomorrow, we have CPIs out of Europe, building permits out of the US, not that incredibly exciting, but the big stuff starting to come in. Wednesday, CB consumer confidence for the US, 3 o'clock London time. Existing home sales, DOE from the Department of Energy in the US for crude oil. Thursday and Friday, by far the busiest weeks to trade this week, guys and girls. So Thursday, you're getting that GDP out of the US, initial jobless claims, fully fed manufacturing, and probably the fully fed, the least interesting of these three here. So 1:30 Thursday, things really going to be picking up. And then Friday, December 22nd, we're going to have core durable goods, but then the big stuff, core PCE and PCE will come in there at 1:30 pre-open, and then new home sales after the open there at 3 o'clock. So quite a busy tail end to the week to close out the year effectively. And so let's get over to a couple of stories that I want to take a look at. And this rally in equities is eye-watering. And I was saying to some traders there last week, these markets seem to be way out on the front of their skis at the moment, pricing in the rate cuts that they presume that the Fed is going to be doing in Q1 of next year. So, this rally has really just had that second injection in the arm from the FOMC there last Wednesday. And essentially, everyone extrapolating from that Jerome Powell is indicating that the Fed are pretty much done on their rate hikes and they're looking now to have conversations about rate cuts, right? And so people pricing that in. We're going to have a look at that now in a second, but just have a read of this article to kind of get a measure of what the market is the positivity, the dovishness that the market is pricing in as it's rallied over the last what seems like nine days here. Just get gold chart there. So if we then go on and look at the kind of between the FOMC, Jerome Powell's statement and speech, he's like the good cop right now in this situation, and he's been like super dovish basically in that meeting. But then you go to the bad cop, which is Goolsby, and Goolsby kind of came out there on Friday and was like, hey, I don't think we are doing, we're not ready to like do all the cuts and we're not there yet. And basically he's just being ultra cautious. So read through a couple of the comments here, but he's saying, they're staying data dependent is what he's talking about here. And really saying that, we have to tread carefully and we've a long way to go for the Fed. It's kind of like, if you want to improve like your marathon time and you're like doing, 3 hours and 30 minutes on your marathon time, for you to then kind of get that 3 hours, 30 minutes down to like 3:15 is way harder than it is to get your time from 4 hours down to 3.5. It's just like the smaller the increments and the closer you get to your targets, the harder it is to get that last gain, right? And so that's kind of what's happening with rates, and they're really seeing that they're going to hit target, I think, in 2025. Now, how is the market pricing this? And this is driving the market. So currently for the January meeting, 31st for the FOMC, 89.7% priced in here that they will hold, and that's fine. 10.3% looking at they're going to cut by a quarter point. But as we go into the end of sort of Q1, right, we can just have a little update here. There we go. So you're seeing, just go to 20th of March. Here we go. So now we see in March is a 67.5% probability pricing in of a quarter point, okay, and 25% pricing in that they're holding. But then when we go to May, you see that, it's only 3.2% chance, priced in that they're going to hold. And now you're looking at, about 80% between these two. It's either going to be a quarter point cut or we're going to be down by 50 basis points from where we are now at that point, i.e. pricing in another cut to come in May. And then when we go to June, it's more disparate across a range of probabilities. But I just, I'll post a link to this in the room. Just thought it's kind of interesting because this really is important and what the market is pricing on at the moment. Okay. All right. right, big story now that's really bubbling up and has been over last week. But the big one is here that these shipping firms, Maersk, Zim, I think it's Hag, they're all now avoiding the Red Sea like the plague. Why? Because these Yemeni Houthi rebels are attacking shipping vessels in the Red Sea. And why is that important? Well, that's important because if we kind of cycle through here to the map, it's important because I will just show you here that the main shipping route for about 23,000 ships a day, all right, coming through here into the Suez Canal are now having to reroute around, I think it's the Cape of Good Hope here, and then around the Horn of Africa, and up we go to Rotterdam, all right? That is a big problem, Okay, so adding 40% in time-wise to delivery there. So, just to kind of come back here, just looking at this, due to the incident and Tech Lives, MSC ships will not transit the Suez Canal east or westbound, all right? And so already reroute around the Cape of Good Hope instead. Now, Maersk have committed to avoiding this area as well. And so this is really going to, look, this is not, all shipping routes affected the way we had in COVID, which then became an inflationary driver, okay? So we're not really looking at this knocking into inflation per se at this time. But if you have, a little more duration to this, and if this goes on for quite a while, for 4 weeks or more, then, you could see a mild impact on inflation, and it's probably going to impact European markets more so than US. But what is important is four articles here on this really. Costs rising after these Houthis target the commercial ships. It's now not just Israeli ships that they're targeting. We're looking down here for oil super tankers, right? Average rates for super tankers carrying 2 million barrels plus of crude have risen to over 60,000 a day from about 40,000 a day. Okay, so that's really inflationary on energy costs there. Okay, alternative routes going around Africa. All right, and just to kind of look at this from S&P Global Commodity Insights here, this is really sums up where the problem is, and then we can kind of think about oil in this situation, right? And so the port of the sort of point here, it's Bab el Mandeb, right? If we look at the map here, Bab el Mandeb, we just see where this is. It's right in here. Okay, it's sort of the entrance to the Suez Canal, which is up in here. Let me drop that and drop that. So the Suez, it's just to get yourself geolocated here. Okay, so you're seeing Israel, Saudi Arabia, the Straits of Hormuz over in here at the UAE sort of pinnacle point here between Iran and UAE and Oman. Very important choke point for oil. But really, the Gulf of Aden here is just before you get into the Red Sea and then head for the Suez Canal. Okay, so they're avoiding this whole area. Okay, so what does that mean? Well, oil is kind of coming out of here over in the Persian Gulf through the Straits of Hormuz into the Gulf of Oman, and then swings a hard right down into the Gulf of Aden through the Suez. Hey presto, you've got oil into this whole area. All right, so there is global impact not only on shipping of commercial goods, but also household goods or whatever and industrial goods. But oil will be impacted by this as well. Looking across the containerized freight index costs, you're seeing not much going on. There are probably about 20 different freight indexes for different journeys that track over time. And over a 5-year look here, this is just a sort of a generic freight index here from Trading Economics. You're seeing, in the grand scheme of things, sort of mid to late 2022, early 2022 was when we kind of topped out at about $5,000 per container freight on this. And then, really as we exited COVID lockdowns, this freight cost just dropped off a cliff. Okay. Baltic Dry Index, again, prices have been up into early December, just coming off a little bit now. Can we reaccelerate here? Probably, but I think, the market will try and price this in very quickly. But then we look at some shipping companies like Zim. So for disclosure purposes, I do own shares in Zim, and you're seeing 18% on Friday on the back of this for Zim, 18% in one day. And before that, I think we had, what was this? 8.3% up day. So it's getting priced in. Maersk getting priced in about 7.5% up on Friday as well. So just thought I'd keep everyone aware of this, because this situation could be a bit of a wet towel for the equities markets and putting a little bit bit of delivery risk on there for these sort of, consumer goods, right? Okay, finishing up on what's going on in oil. Well, the US frackers are back. Okay, why is that a problem? Well, if OPEC Plus are cutting into the market, 2 million barrels a day cut through to the end of Q1 2024, to try and tighten the market and keep prices elevated. Well, US frackers coming back to drilling, and it's actually more pumping at the moment, but now they're starting to drill, baby, drill. This is a problem because these guys are now, I'll show you the chart, because these guys are taking US oil production from what was forecast to be about 12.2 or 3 million barrels a day to now what is about 13.3 million barrels a day in the US. So it's drill, baby, drill, and it's pump, baby, pump. And actually, if we scroll down here, we can see that the rig count, as in the number of rigs going to work, which is in red here, has actually been dropping off a cliff. And that's no surprise to anyone. But what is sort of a surprise here is the re-elevation production. So, and this is to do with basically there's no new rigs going to work because these oil and gas companies in the US are really, pinned to returning shareholder capital and, via dividends and all sorts of different ways, but mainly through dividends. And they're not splurging on getting new rigs out into new fields. What they are doing though, and what we can see from this chart, is they are maximizing the BJs, as we say in Ireland, out of the existing oil wells that they have. Okay, and that's to do with some improved technologies for reworking the hulls, essentially, that have the oil in them. So re-stimulation, all this sort of stuff, and they're getting more out of the existing asset base. Okay, is that it? Just to finish up here, OPEC oil, talking about, they've seen how the market is pricing in downside of the cuts ending in March next year, at the end of March. And so now Prince Abdulaziz bin Salman, he's the kind of Saudi energy minister and the sort of big boy in OPEC. So he said, you know what, we can push these cuts past March. So that's going to kind of, traders may want to price that tightness in a little bit here. Okay, something else I'm not going to get time to cover here in the articles, because I do want to get to the charts, is that the war front in Israel is picking up in the north against Hezbollah on the border with Lebanon. And I think this is kind of getting a little bit priced into oil at the moment, but we are going to need to hold over 69 whole handle on WTI for us to really be able to get into a nice long-term position. We've been up on Friday on oil. Actually, no, we closed down a little bit, but on Thursday we were up quite a nice amount on oil. So let's get over the charts here and see what we can see. And I'll just use this chart here. And so while we're on oil, we'll just cut right over to looking at oil on the daily bar chart here, and we'll just turn on the current line so we can do this. So we've come into this figure 67.98, call it 68, and I think we can get back higher here. Essentially, I think we can get back higher. So we've kind of tagged into sort of a general area down here. You've seen kind of the lows of March this year, and then we've catapulted out of there, and we've tagged a little excess low down here around that 68 handle, and buyers are loving it. They're coming in. All right, so I actually think we're going back up. There may be another rattle of this level to the downside, but basically if we break 68, if we close today below 68, I mean, it's pretty scary what lies below for oil, right? And you can see that here, precisely 67.98. These charts are non-adjusted, non-back adjusted. So if you're trying to marry up candles and levels and whatnot, you'd need to be using a non-back adjusted chart. Now, why do I say it's good night stakes for oil below 68? Well, really, the next stop below there is 62.5, and you probably say there's an interesting area of a couple of levels here at 61.71s, all right, because if we break here, good night. Now, why would that happen? Fundamentally, that would happen because these oil drillers in the US are getting back to splurging and really flooding the market as fast as they can, because ultimately they want to make money on their existing rigs and with their existing assets. They just want to maximize the profit potential of that elevated oil prices. And what will solve that situation as we go, down below and probably below 60, which will kind of put the skits on that raised production. But for now, I think North America, they want to pump, baby, pump, and they're also probably going to get these fracking rigs to work. All right, that's oil. So for the week, what's the trade for the week, Tim? As I hear you ask on oil. I think we could get a retest test on the 68s. I do, and I think I'd be buyer there. Really massive risk reward. Trade it on front spreads, trade it on back spread, trade it on the front month outright naked. And look, I don't care what you do. I just, like this. I wouldn't really give this risk below 67. Well, let's say, yeah, below 66.80s. All right. So that's, it's about $1.20 there, right? You could try to take pot shots that comes down to these levels, 67.03. Maybe that's what we need. Pierce this, flush out a low, and then we're off to the races back up. So keep an eye on this area here. If we close below, the 67s, I don't think we're going to survive. So for me, yeah, you could even take a day trade, 67 or 69.72s. Look for a little bounce of maybe $0.50 from that. But then I'll be all out. But we're long at the moment. So we need to get up to 74.64s at the moment, I think. Sorry, 73.6 is the next level up for me on oil. Sorry, that was the wrong chart. I dipped off of there, but we'll get that one back up. All right, looking at the S&P 500. I mean, look at this chart. Like, it's just, it feels like it's about to fall over backwards at the moment, doesn't it? So, I mean, way out in front of its skis, pricing in the cuts. Now, this is a non-back adjusted chart, so I do have the non-back adjusted all-time high, 48.08 quarter. We're nearly there. It feels like we could just tag it and then just go back to bed and flop over and try and seek for buyers, on a pretty decent pullback, I would imagine, right? So I think that's what may happen there. So keep an eye out for that 48.08's tag, and then we come back to at least 47.40 half. I don't see us tagging this and running on out of Thursday, Friday data. So be careful there. So kind of what does this look like on the 30-minute chart? Well, we got this nice area of consolidation here. 47.67's quarter to 47.91's even. You've seen that 47.91's even level just, dissipate, trade back down. It was a really nice trade here for the guys in the room last week. And the short on the top, I have to say as well. But I suspect we could probably pull back to 47.40s before Thursday, Friday, and then try to rally. We could probably try and get this in before Wednesday, rally back to here, and then hit this all-time high. And then, who knows what? But there are non-back adjusted levels above here, 48.62s. Or sorry, these are back adjusted levels, and the back adjusted all-time high is currently at 50.31's half. All right, so 5,031 and half. That's the back adjusted high. Okay, so all-time high. All right, so just making you aware of some of these levels, and ultimately, I think if we get a hell of a pullback, it's going to be 46.92's even, and then we bounce. So if we can't, if we start to dissipate and come down here on whatever risk, Tuesday, Wednesday, I think by Thursday or Friday, if we tag 46.92's, buyers will be coming in there to protect that level, and we go up. Okay, we go up. So that's booze. What else here? Really, gold. Yeah, gold and the dollar. All right, so let's look at the dollar first here. Okay, so here's Dixie, and ultimately we have been in this bear flag, right? We've been in this bear flag, and we popped out. I think really gave it up there, probably 31st of October. So Halloween, down we come. All right, and so the dollar is trying to hold on for dear life here and take a bounce pullback, and I think it could go back to probably the 2020 high, which it seems to like to oscillate around quite a lot at the moment, which is about non-back adjusted 102.99 there. But while that happens, I think gold is weak as a kitten. I think ultimately dollar needs to crush lower, but maybe not today, Zerg. So looking at gold, where are we? Gold. Sorry, I was looking at the euro there. Gold. Here we are. So yeah, gold. Look, we had this spike high to a new all-time high there just a short while ago, and I think we're dissipating back down. I think it's 1976s. I talked about this, probably 1971s for the pullback, and then I'll be looking to buy gold, right? But until then, we are short in Duggan Capital, and we have been since what was this? Wednesday? Was that? Oh, sorry, Thursday last week. Post FOMC, bid to the highs, 2063s. There you go. That's the short that we're on here. Ride 'em, cowboy. Down we come. All right. Next target down, 2020 spot 2. And yeah, be careful of buyers coming in, trying to come in at 2018s. That might be a bit messy. If we look at that on the 30-minute, we do this. Sorry, normalize this chart a wee bit and make it a wee bit cleaner. But you can see here, I've already on this chart, I'm already looking at that 1976 pullback for the long and get out of the shorts. I'll be taking something at 2020s for sure, and then kind of it'll be a rough ride of buyers trying to come in from 2018s, and then I think they'll get sold sold down ultimately. I think they'll get sold down. So that's gold. All right. So be careful there on gold, boys and girls, as always. And yeah, look, nat gas is it's weird, right? You know, nat gas is so you know it's like if they forecast a cold spell coming in, nat gas will get sold down. All right, because everyone's too late to the trade. Essentially, if you're hearing about like a cold spell coming in, you're already too late. You need to be looking at weather models. You need to be on top of this stuff, and you need to be looking at seasonal trades on nat gas, right? Be effective and be making money and be on the right side of the tape. Now, with a warm front in North America, all right, what's happening is there is a warm front kind of forecast to sweep over America, this North Continental America this week, potentially next week, and we're now bid on nat gas. So it's coming out of the lows. I think it had like a 8% up day on Friday. Actually, I can't remember. Let me see. What was it here? Chart calculator, imbalance trade up. Yeah, 6.9%. Very well on the breath. From the open to the close, it was 3.1. But from the low to the high, it was 6.7%. But ultimately, not a bad week for nat gas. Closing the week 11.1% and bid again. I'd be really careful here, guys, on nat gas. It will take your money. It's one of the widowmaker type of trades, but I think this thing is going to cruise on to 2 spot 7s, and then it'll probably continue selling down. Okay, so I think a lot of people are going to come in Johnny come lately to this trade, and then they're going to get reamed at 2 spot 7. But if they're in here today already, they're probably going to be making a lot of money on that trade. But then I'll be flipping at 2 spot 7s on nat gas. All right, be careful out there on nat gas. I haven't really got anything else for you other than to say, listen, it's been a hell of a year. Interesting as always. You know, I want you guys to all have and girls to have a fantastic Christmas from all of us here at Duggan Capital. There will be a 2024 look ahead video coming out. It may be released after Christmas Day, but before the end of 2023, it will be out there, guys and girls. I got a couple of videos, interesting interview with Brian Lee, ex pro gamer turned trader. Fantastic chat with him. And yeah, listen, have a great week. Stay lucky. Cheers.